Yeah, I think maybe there's a little bit of over extrapolation in the sort of consensus forecasts for next year from the productivity outturn in the US from last year. Like I love the trend in productivity growth in the US. I just think that in terms of like how that's getting priced into markets, we've already had that kind of validation that the US can perform in terms of productivity growth, whereas we haven't had that with regards to the rest of the world. And I think we will get it this year. And then in addition to that, when we think about like the conversation you were having with Neil was fascinating because it's like there's this statistical way of calculating productivity growth, but then there's this kind of nebulous thing, which is like total factor productivity growth trend.
Right.
And we all like to sort of extrapolate from the statistics. But actually, the statistics last year, I think there's a little bit too much of a tendency in investors to sort of think that that is just that productivity growth outperformance is a clue that the US has cracked the code on AI and the rest of the world is
Yeah.
just a little bit too sleepy to do that. Whereas actually probably what's happened is that in the numerator of that productivity statistic, you've got all the AI capex, and in the denominator, you've got all the uncertainty of tariffs and companies not hiring. And so actually it's just a sort of temporary boost to
Right.
productivity
And
growth. And if you get reacceleration in the labor market, then it's gonna turn out to have been a bit of a mirage.
here's a productivity math, Paul. Good morning, Pittsburgh, Pennsylvania. Zuckerberg is buying nuclear, like data centers, including on the Ohio River, 27
Yep.
miles from Pittsburgh. Pittsburgh's utility bills just went up 10%.
Yep.
That's what people, there's the productivity from razzle dazzle AI on the Ohio River. Their utility bills up 10%.
Freya, how would you characterize the U.S. labor market here? I mean, if we're at sub 100,000 kind of job creation monthly here, yet I don't know, it just seems like a low hire, low fire type of environment. Is that how you see it?
Yeah, it totally is. And so we can't actually sort of extrapolate anything from the historical data on the weakness of the labor market because it's not like that weakness is not an indication that we're pre-recessionary. I think the main kind of buffer against that is that there's still a very large gross profits margin there to prevent companies from actually having to fire. And with that sort of the COVID experience, recent the shortages in COVID, and knowing that there's going to be shortages because of lack of immigration, it would be weird for companies to actually get out there and fire. And so as soon as you get this kind of reacceleration in and growth has been strong, you've had that productivity growth. In a sense, actually tariffs have been absorbed into that sort of statistical mirage of productivity growth rather than anywhere else in terms of squeezing margins or passing on to CPI. But if you then get a kind of recognition of uncertainty, at least sort of stabilizing and acclimatization to this environment and recognition that at some stage companies have to get back to hiring, then you're going to get the productivity numbers coming down. And when we think about, you mentioned 100, sub 100, that's probably if you get anything between 60 and 100 with kind of arrests the way they are at the moment, that's probably still going to tighten the labor market.
Productivity, I mean, is the U.S. is productivity materially higher than, I don't know, the UK or Europe or certain parts of Asia?
As measured right now, the US has outperformed hands down, no questions asked, in terms of the recovery from COVID. But the
I don't
US
feel
got
that way
that
up
kind
though.
of fiscal stimulus in one way or another. They got it right from the productivity standpoint. But going into this year, essentially the question that I'm sort of asking myself is we've got fiscal demand impulse in a lot of major economies. Is the supply side going to be able to respond to that? Because if not, you're going to get inflation being stickier and the central banks having to take away the punch bowl. And where they don't feel, for whatever reason,
Right.
politically, that they can take away that punch bowl, the bond market will do it for them. So I'm looking
Uh,
for private sector capex that can respond to investment from the government that has been under investing for a long time in the likes of Germany. I'm looking for a lot of women that have been incorporated into the labor market in Japan, but they're very underemployed. So you get
right.
that fiscal stimulus and you get supply side
Right.
response. I think it's best outside the US.
Freya, we got to go, but you got a cottage industry and an analysis of the market economics of China. I'm getting percolations that China's pretty much bottomed and we could actually get some form of GDP stability and even a pop. Do you buy it?
Yeah, I do actually. I think, the key thing that I'm looking at in terms of long-term returns for China is the working age savings rate. If they can get those animal spirits up by kind of rolling that ball of money around the equity market in the closed system, maybe they can help a little bit with that. But even short of that, in a short-term sense, I think that they're going to do another kind of round of fiscal stimulus in the Chinese economy. You will get a few quarters of growth out of that.